let's bring in Hamish. And thank you very much indeed for talking to us about Scottish Mortgage this morning. So I'm going to hand over to you and tell us about the trust, and then we'll have some questions from the audience. So if you've got a question for Hamish, please do put it into the YouTube chat box. Thank you.
Hey, thank you. Hi, everyone, from a slightly grey and drizzly Edinburgh morning. I'm Hamish Maxwell, a director with Baillie Gifford and an investment specialist with Scottish Mortgage, which is one of the UK's largest investment trusts and Baillie Gifford's longest standing clients. If we move to the next slide, and we can see our purpose at Scottish Mortgage is simple, which is to maximise total returns over the long term. And we aim to offer exceptional public and private growth companies from around the world in one liquid and low-cost portfolio. And this is a rare combination. The businesses we want to own are addressing large and growing opportunities. They have strong competitive advantages. They're disrupting their industries or even creating new ones. And many are founder-led with cultural advantages too. But exceptional companies don't change or create new industries overnight. It takes 5 to 10 years or more, and there will be mistakes along the way. And that's why our end of the bargain is to be patient and supportive shareholders, because if they're successful, the rewards can be profound. Talking of which, on the next slide, we can see the relationship between Scottish Mortgage and Baillie Gifford, which goes back over a century, and it has created very strong long-term returns. This is our share price chart over that last 100 years plus. And apart from inevitable moments of adverse sentiment, like the oil shock, the dot-com bubble, global financial crisis, and post-COVID, Scottish Mortgage has been a very successful investment over the long term. And it's pleasing for us to have delivered those good returns. But looking forward, as I'll explain, we think there's lots for the patient investor to be excited about. And on the next slide, we're showing certain characteristics which we think are important for good growth investing, but we also think they're quite hard to find in the investment industry. And I'll make the case that Scottish Mortgage embodies these characteristics, which make it a distinctive investment. We are not interested in the status quo at Scottish Mortgage. We're interested in the future, in new ways of doing things, and in growth. On the next slide, we're looking at the first characteristic, which is seeking outliers. And please don't feel the need to read all of that heavy footnote just now. I'll talk to the big picture, which is the asymmetry or the skew of stock market returns. And it's very clear. And I think it should inform decisions about equity investing, because the stock market is made of thousands of companies, but returns are not evenly distributed across every company. The stock market is just not fair in that way. Rather, the biggest returns are driven by just a few of the most successful businesses. And the extent of this often surprises people. And we're showing here a study from Professor Hendrik Bessenbinder from Arizona State University. Of the 61,000 listed companies globally since 1990, over 60% of them underperformed T-bills, which are US government short-term bonds, so basically the risk-free rate. 38% of them merely offset that value destruction. Only 1.5% of listed companies created all of the wealth above T-bills, which was $44 trillion. So in other words, when you're seeking the best returns, only a few companies actually matter. Now, to own the biggest winners, you can invest either passively, in which case you're guaranteed to own them because you'll own the whole market, but you will dilute your returns with the 98% of the market that equates to T-bills in aggregate. Or you can back a stock picking process that aims to invest in just the biggest winners. And in that case, your returns might be exceptional. On the next slide, we can see that asymmetry has been at work in the Scottish Mortgage portfolio. Our good long-term returns have been driven by just a few big winners. Now, inevitably, we experience losses in some of our holdings. We're taking risk for return. For instance, Northvolt, one of our private companies in the battery industry, recently struggled through lower than expected demand and problems ramping up. And you can see that among the biggest losses at the bottom of the page. However, the most you can lose in one company is 1 times the original investment. But the returns from the biggest winners can be unlimited. So our gains from SpaceX last year alone were much greater than our losses from Northvolt. Longer term, Nvidia, the AI chip company we bought in 2016, has grown 80 times in a decade. Tesla, we bought in 2013, grew 25 times in size before we started selling it down last year. And Ferrari and semiconductor company ASML each grew near 10 times. So our biggest winners have substantially outsized our biggest losses. Now, on the next slide, we can see that the best performing long-term growth companies are also often the most volatile in the short term. For example, look at the growth of Nvidia on the left and Spotify on the right over the periods we've owned them. Really good long-term growth comes with short-term volatility, shown by the orange bubbles on the slide. This is because different variables are playing out over different time horizons. So long-term returns follow profits because investors wish to own the biggest cash flows. So companies that grow their profits 5 or 10 times in a decade are worth more as a result. Whereas over the short term, share prices are unpredictable. Stating the obvious, future profit growth hasn't happened yet. It must be forecast. And the market's ability, often its willingness to forecast profits, is affected by all sorts of things like the emotions and sentiment of news, trading volumes, and let's face it, lots of unpredictable politics and economics. So to seek the best rewards, we have to be patient even during inevitable periods of adverse sentiment. The next slide, we come to our next characteristic, which is the belief, our strong belief that change drives growth. If you want to invest in the biggest winners, one approach is to look for the companies that are harnessing valuable change, like new science, new technology, new business models, and new demand. And this link between change and returns is the intuitive combination of a couple of facts. One is that profits drive share price over the long term. And two, consumers prefer to spend their money on new and improved products and services, which a few visionary companies go about providing. So think of all of the historic, valuable industrial revolutions like steam and electricity and flight and computers and the internet. But now think of the process of industrial revolution as ongoing. So artificial intelligence, genetics, robotics, connectivity. What an exciting time to be investing in growth trends like this. And today the stock market is worth over $70 trillion, an enormous amount of money. But most of the thousands of companies in it are being disrupted by a few innovators. And that's the exciting opportunity we find for investors. So on screen here, we're showing growth trends in the Scottish mortgage portfolio, which include the evolution of transportation with electric vehicles by BYD, drone deliveries from Zipline, and air taxis by Joby, the digitization of finance with investments in Stripe and Wise, and transformation of healthcare with Tempus and Recursion. This is just to name a few of our holdings which are driving change and therefore we think driving growth. On the next slide, let's have a look a bit deeper into one of the examples, which is artificial intelligence, because it's been talked about for years, but it's finally here and it is changing the world and it's certainly been driving the market. Phase one of artificial intelligence is the hardware that makes it possible. So our holdings here include Nvidia, TSMC, and ASML. You've got Nvidia designing the best chips for AI, TSMC making those chips, and ASML providing the machines for TSMC to do so. Next in the supply chain are the companies that are actually using the chips to make enormous AI models, like cloud providers, network infrastructure, data analytics, and security. So think of Amazon, Meta, Snowflake, and Databricks driving the CapEx and driving the progress. And then we've got the companies applying AI to their business models to grow their revenue and improve their margins. And there are lots of examples in our portfolio. Meta, Meituan in China, BYD also in China, and Tempus for healthcare diagnostics. These companies often have in common the benefits of being led by technical founders, of scale, and of deep pockets for investment. On the next slide, we look at the next characteristic, which we think gives us an edge, which is our structure as an investment trust, which we've had for over a century. So this closed-end fund basically means we sell that a certain number of shares to raise that certain amount of capital. So those shares traded on the market, that capital which is invested by us in growth, companies, that allows us to focus on the long-term investments without the need to liquidate assets prematurely. We do aim to actively manage share price around net asset value. We've heard a bit about that this morning at the sector level, and I'm happy to take questions on that. We also employ some modest gearing, aiming to enhance long-term returns. And returns have to exceed the cost of borrowing to help, not hinder, but our careful management of that over time has been a contributor. And one of the largest UK investment trusts and a member of the FTSE 100, liquidity is there when it's been needed. And we do keep our fees low. We have scale, and that translates into lower costs, which have been 31 basis points, so well below the average. But key, I think, for the investment trust structure in our approach and our portfolio is that it allows us to have up to 30% of our portfolio in private companies, which are illiquid, but our closed-end trust allows us to offer them in a liquid form. Which on the next slide, we come to now this characteristic, which we think gives us a real edge, which is our private company exposure. Because many growth companies are now staying private for longer. So the relevance of private has been increasing. If you think that the average age of an American company at listing has gone from around 8 years at the turn of the millennium to around 12 years today, and the amount of capital and late stage private markets has grown enormously to $2 trillion plus today. So for us, whether it's growth of late stage private or growth of listed, what we're looking for is the best growth. The IPO is effectively another day in a company's growth cycle. And our blend of public and private growth, we think, is exposure across more of that overall cycle. On the next slide, we can see our exposure to private, which is currently around 28% of the portfolio. And it includes 6 of the world's top 10 most valuable private businesses. Our largest position is SpaceX at around 7% of the portfolio. SpaceX is leading in the low-cost space logistics and satellite internet connectivity. And we invested when it was worth $30 billion. Now it's worth $350 billion. We have ByteDance, which is another of the world's largest private companies and the owner of TikTok. And ByteDance is changing how digital content is produced and consumed. We invested when it was worth $75 billion. Now it's worth $300 billion. We also have Stripe, which is digitizing payments and making inroads to crypto. Now, these are among other exciting investments. But our private portfolio has got strong fundamentals. So half are cash flow generative, others have healthy cash balances and are on paths to profitability. And most of our private investments are in mid to large cap, worth up to $10 billion or more. We aim to offer exciting private investments like these with strong fundamentals and high growth potential. On the next slide, we're highlighting the point that even if equity portfolios wish to own private companies, that doesn't always mean they can, because private companies get to choose their investors. That's a key difference with public markets. Our reputation as long-term supportive shareholders often makes us preferred investors. And many company founders approach us directly or through introductions, and this gives us access to high-quality deals and long relationships with visionary founders. We've got a well-resourced private companies team at Baillie Gifford and a rigorous valuation process our investors can trust. And on the next slide, we come to the fifth and final characteristic that we think gives Scottish Mortgage its distinctive qualities, which is our mindset, because we do aspire to be curious, patient, and brave. On the next slide, we're referring to how curiosity matters, because to beat the market, you need different views to the market. So we don't focus on the short-termism or the consensus of the finance industry. Our information sources are open-minded, such as academics, research groups, expert networks, and private companies. We view growth trends like healthcare and renewables and transportation as real issues needing practical solutions, not just as abstract financial concepts. On the next slide, we see how patience matters, because you do not drive transformational change overnight. It takes 5 to 10 years or more, and again, there will be mistakes on the way. And the evidence shows that the market is focused on the short term, 1 to 2 years at best, whereas our average holding period is very near 10 years. Patience allows the capture of compound growth and avoids costly decisions. And on the next slide, You see why we think that bravery matters, because reward comes from taking risk. And we're showing here our high active share and differing concentrations to the market. We have to stand apart from the crowd and embrace the unconventional. We need the courage to invest in transformational growth, even when it's out of favor, and not just in the Mag 7. And you can see our exposure to growth is around the world, including the US, but elsewhere too. On the next slide, the penultimate slide, we can see the resulting portfolio, which has delivered strong sales and earnings growth, 2 to 3 times greater than the benchmark. And this matters because we know that regardless of short-term sentiment, it is sales and earnings growth that drives share price over the long term. And then to the final slide, just in summary, before welcoming any questions. Our purpose, again, at Scottish Mortgage is very simple, and that's to maximize total returns over the long term. And we aim to offer exceptional public and private growth companies from around the world in one liquid and low-cost portfolio. And notwithstanding inevitable periods of adverse sentiment, our approach has been very valuable over the long term, which is pleasing. But perhaps more importantly, as I hope I've given you a sense of, we are truly excited about the potential for our growth portfolio from here. Thank you very much for listening. I'll be delighted to take any questions.
Brilliant. Thank you very much, Hamish. We do have some questions for you. Let's just bring up the performance side while we're talking about it. So, I think actually an interesting one, because obviously us ordinary mortals can't get hold of investments in these private companies, but there's a question really: how do you get hold of them? How do you end up being invited to participate in Spotify or Tesla or SpaceX? How do you end up becoming an investor in these things?
Yeah, there's a very human answer to that, I think, which is relationships and reputation matter. So Baillie Gifford being very well known as long-term patient supportive shareholders, and for Scottish Mortgage, a longer standing client, you could see that very long-term average holding period, 9.8 years is our average. Investors get a sense that we are genuinely long-term. Lots of managers might say that, but we can evidence that. And we see our role with private companies and with our public investments as being engaged and supportive, but not trying to commandeer or dominate the strategy. We invest in the companies because we think they're going in the right direction, but we're going to engage with them and give feedback. So I think that reputation helps, but also I think introductions help as well. So having been long-standing investors in Tesla, the introductions felt a bit more natural over time as we got to know SpaceX and the team there. So I think highlighting the human aspect, it's not a case of every company can do it, but you have to work hard to safeguard that reputation.
Yeah, thank you. How much do you worry about geopolitics, macroeconomics, that sort of stuff? What's emerging markets versus developed markets and exposures to that? I mean, is that something that affects the construction of the portfolio? Is it something that actually drives buy and sell decisions at all?
I think there is very clear evidence that in the short term, the market has become more volatile. And you can see that around significant events like what the market considers significant events like earnings calls. Volatility has certainly been increasing recently. And volatility did return to the market a little earlier in this year, precipitated by macro decisions from the US. So in the short term, the market can feel frustrating and it can feel very stressful. And that's very human. It's really important, we think, therefore, to remember what drives success over the long term. Because again, the evidence is clear. A strong correlation between companies that grow their top line and their bottom lines faster than the rest of the market. They will experience the best rewards over 5 to 10 years. So the continuing existence of that as a North Star is really important to us. And it allows us to focus on what we think matters during stressful periods in the market. In addition to that, we're looking for companies that are well-led, are resilient and adaptive, and are able to pivot their business when necessary to continue to capitalize on the long-term success. So Mercado Libre, for example, in Latin America, has grown up in an environment with lots of macro stresses and has built an incredible logistics network and fintech business. Spotify has done great work to continue growing its listeners while also improving its margins. Shopify returned to growth by using AI to keep down costs and reduce headcount while growing the business. And there are many others too. And it's that sort of adaptability and resilience with strong financials that we look for.
How do you decide whether something's going to run its course and it's time to sell it? When do you pull the trigger on that?
So for every company, the question and answers are unique. They're idiosyncratic. And we are bottom-up stock pickers. But we have a framework which we apply in our research, and this can be a consistent framework, regardless of the company and regardless of the sector it's operating in. So the key question for us, if we're looking for exceptional growth, is what is the potential large market opportunity? How is an industry being transformed or in fact totally invented? So, how is transportation being transformed by electric and autonomous? How will logistics and satellite connectivity be changed by what SpaceX is doing? How is commerce and finance being changed in Southeast Asia and beyond by Sea Limited? So, what is the grand change that's taking place? And then the question is, what is the company's competitive advantage? How is it investing in its future potential? How is the company being led in such a way that differentiates it, but also has that long-term view? And therefore, considering the total opportunity, what is the probability of success? And then to come to the question, James, is that probability increasing or decreasing? And this is a matter of using the broadest sources of information, getting to know the businesses as best we can. It's often a qualitative approach, and it's one that takes time and careful analysis. Ideally, we'll see a company growing over time and be gradually reducing it along the way, making reductions along the way as it's growing.
If you want to sell a private company, can you do that easily, or is that something that's just going to take a lot longer than it would do?
Yeah, it depends. You put your finger on the key restriction when it comes to private versus public holdings. There are a number of different opportunities for liquidity. First of all, the one perhaps most discussed is the potential for IPOs. The IPO market has been slower recently. There is early signs that it's starting to open up. I wouldn't want to time that, but we believe it will be profits that drive that improvements over time. There's also the possibility of companies offering investors liquidity. And a number of our private companies, as they've been growing, have indicated to us that would be a possibility. They'd be willing to discuss it. They might be willing to buy back shares. And there is also, on a case-by-case basis, the potential for secondary market investors. That comes down to the agreements which we form with the companies we invest in at the time of investment, whether that's possible. But that is often an option. So the opportunities are there, but it's certainly one to be mindful of.
Cool, thank you. Now, a few stock-specific things. SpaceX first.
Yeah.
Obviously, was going great guns, and then you've had this massive falling out between Trump and Musk, and Trump saying, I'm going to deport you to South Africa, and I'm going to cut all your subsidies and all that sort of stuff. Is that scary, worrying, something that you changes your opinion on the company?
The company itself is frankly extraordinary. This was a business which recognized that the model for spaceflight was unsustainably inflationary. So from going from the Mercury to the Saturn to the space shuttle program, it was getting more and more expensive and therefore less and less sustainable. And this came down to the model of how you design and build rockets. The original theory was that you design and perfect each part and combine them into the rocket only when you're utterly happy with every part of the design. And this took a long, long time. SpaceX rewrote that and said, be quicker with the prototypes, be willing to accept rockets will crash and explode, but learn from that. And therefore, the pace of progress has been enormously impressive. The reusable rockets they've developed have been driving down costs for the first time ever in the space industry, and it's allowed them to develop a de facto monopoly when it comes to launch. Their customers aren't the US government, but they're also large telecoms companies. So these are large and valuable relationships with big customers, big sticky customers. Add on to the fact that they've been developing this incredible satellite connectivity network. Starlink, which has already got 5 million customers. Combining those things, we think this is a truly exceptional business, which is very, very well led. The controversies which you refer to with its founder, are well known and well publicized, and I wouldn't add to those. It's certainly something that we will continue to keep an eye on. But the pace of progress, the operational progress of the business itself, is what has drawn us to it, and we think continues to provide amazing opportunities.
Brilliant, thank you. Another Trump-related question: what do you think is going to happen to TikTok? Obviously, that you mentioned ByteDance, and it's a big chunk of its business.
Yeah. The short answer is we have absolutely no idea what will happen when it comes to US government policy, and the ongoing disputes and trade wars between the United States and China, I think, will probably continue to dominate headlines and the consciousness of the market for some time to come. We therefore consider our investment in ByteDance and TikTok in the context of its Chinese opportunity, the rest of the world opportunity, and then the United States opportunity. And if you exclude the United States from TikTok and from the overall business, we still see an incredibly attractive company with billions and billions of users on its network of social platforms, and an amazing use of AI to improve the user experience and deepen the user engagement over time. And this can be extraordinarily cash generative when it comes to advertising. So yeah, it's I wouldn't say it's ideal, but it doesn't derail the long-term investment case. We would think of the US as being optionality to the broader value of the business.
Good, thank you very much. How long a sort of run of AI-driven growth have stocks like TSMC and SML got, do you think?
Well, for us to invest in a company, we need to believe that there's growth potential over the next 5 to 10 years. And, that would therefore be an indication that when we hold a company like NVIDIA, TSMC, ASML, we still see potential over that time frame. But if you think about the direction of our holding and our investments in those businesses, we more recently took a holding in TSMC, and we have been reducing our holding in ASML and NVIDIA. And I think that's in reflection of the fact that NVIDIA has performed outstandingly well, close to $4 trillion of market capitalization. But if we're asking the question, could this company double or quintuple over the next decade, that becomes harder. I think NVIDIA is going to remain an extraordinarily important business. Its chips are right at the heart of artificial intelligence. But we do have a sense that there's going to be a broadening out, democratization of the design of these chips, because they are going to become so universally used. And NVIDIA's margins over time, we think, are unlikely to stay as high as they've been, although we don't think there's going to be a sudden shock to them. We don't get a sense of that. So we have reduced NVIDIA and took lots of profits. ASML, likewise, has been one of our better longer-term performers, and we've been able to take some profits from that business. Its EUV machines have led this latest progress in computing power, and we think will continue to do so. But we don't expect EUV to be the dominant force forever. So we're mindful of that fact, and we're thinking about what might come next after the next 10 years. Then look at TSMC. Here is a business which is actually, relatively speaking, agnostic to whatever the machinery and design is. They say to their customers like NVIDIA, you design the chips and we'll make them for you, and we'll use the best machinery, which is ASML's machinery. But in future, TSMC has the option to invest CapEx in other machinery. And that's why we think it has the potential to be flexible should it require. The question then is, what is the upside? Well, if it's worth nearly $1 trillion, could it be worth $2 trillion plus? We believe that absolutely is a potential over the next decade or so. And this comes down to the broadening out of the use cases of connectivity with devices, data production, and data analysis, which we think has had this sharp spike, but is only, we think, going in one direction. It's only going to increase. More connected devices, more people using them, more data, and more value in analyzing it. So we think this is an exciting trend.
Brilliant, thank you. Now, Mercado Libre is one of these stocks that most people wouldn't have come across, and then suddenly it sort of exploded onto the scene, and you did well to pick up on it early. Are there other kind of hidden gems in places like South America that we don't know about yet that you're looking at?
Latin America is a very interesting place with a 700 million people, changing demographics, and increasing middle class, increasing consumer spending, and a growing tech ecosystem, which we think can be ambitious over time. That's the backdrop. But we are bottom-up stock pickers, so where have our interests taken us? We've been very fortunate to have an outstanding relationship with Mercado Libre over a great many years. Lawrence, who is the deputy manager of Scottish Mortgage, has a really strong relationship with the founder, Marcus Galperin, and has had tremendous access in meetings. And indeed, the senior leadership team visited us not long ago in Edinburgh, and we find that sort of insight really, really useful. It's about understanding their drive to improve logistics, which they have been doing successfully, the growing relevance of their e-commerce platform, but also then how that extends into a need for a financial platform because of the underdevelopment of the banking system. So that's been a really valuable investment, and we've learned lots from it. We also recently took a holding in Nubank, which is focusing specifically on financial services, and is an extraordinarily long-term focused, driven, ambitious business, which was founded on the principle that the existing banking system was far too expensive for the majority of people in Latin America. Half of the people there were underbanked, and they use a digital format to offer cheaper banking. They've been rapidly growing in Latin America, but they do also have ambitions elsewhere too. So these are two examples. I wouldn't want to comment too broadly on the overall sector or an index investment, but I would expect Latin America to be a place where we're able to continue to find exciting ideas like this.
Oh, thank you. Defense is one of these things that has sort of exploded, and there's a lot more money going into it. More and more governments committing more and more GDP into defense. Have you got defense exposure within the portfolio? Is there stuff that you wish you owned or you're looking at?
Yeah, so we don't have a direct defense exposure. We can't hope to have exposure to absolutely every one of the big upside companies, although we would challenge ourselves to find the very best of them. It has been a mistake not to own a leading defense company. We did own Palantir and sold that a few years ago based on our concern of over-reliance on certain government contracts and not being able to broaden out to more private customers. That, in hindsight, has been a mistake. That has been a good investment, but we do take heart from the fact that in our portfolio we have had companies like Nvidia, Amazon, Matron, Spotify, and Ferrari, which have been multiple growers over the last 10 years.
Okay. Last one, I think, because we're nudging up to 12 o'clock. The discount, obviously, was trading at Asymmetry for a long time. You should have stopped. Then it went out too wide in March 23 there, looking at that chart. It's coming back in again now, and it's a bit more reasonable now. Do you see that it's going to close again at some point? What do you think might the driver of that be?
Yeah, thanks, James. So yeah, on the slide you were showing that the chart on the bottom right there was NAV, but it was par and above par for some years, and we were issuing capital. Over the very long term, the correlation between share price and NAV has been very close. Over shorter periods, it can diverge, and the divergence is often linked to sentiment. We entered a period of more negative sentiment in 2022, 23 because of interest rates and inflation, among other things. But what we've seen since then is two things. One, the board committed to a buyback program, which has been ongoing and has been £2 billion. And two, the progress of the investments we've been making, and I've referred to some of the examples, the operational progress has continued going in the direction we'd wish, which helps over time to restore sentiment. I wouldn't make any timing calls on when it might go one way or the other, but our belief in those two things has been, it's had a positive effect, and we would wish to see that continue.
Okay, thank you. There's a very important slide for you to read, pause and read later on, and some glossary stuff. And a legal notice from us too. But thank you very much indeed, Hamish, for your time this morning. I hope we got to most of the questions. And if we didn't, please do drop us a line and maybe we can try and answer them. Thank you also to Andrew. we will be back next week, and I'll be talking to Charles Jennings from Utilico Emerging Markets. So thank you for everybody for your time today. Thank you.
Thanks, Andrew.